Today is Thursday, January 29th, 2026, and the market is currently open. Rezolve AI Limited, trading under the ticker RZLV, is currently priced at $2.90, having moved down about 5.25% so far in the intraday session. While most of the market is looking at this as a simple post-offering cooling period or a typical small-cap pullback, the real story is much more nuanced. Just a week ago, the company closed a massive $250 million oversubscribed financing deal, which essentially gave them one of the cleanest balance sheets in the entire AI commerce sector. For a company with a market cap sitting right around $1 billion, having a quarter of that value in fresh cash is a data point that has yet to be fully digested by the algorithms or the retail crowd. The common belief right now is that Rezolve is just another speculative AI play, riding the coattails of giants like Microsoft and Google. Investors see the recent price drop from the $3.10 level as a sign of weakening demand, or perhaps a lack of faith in the management team after 2 rounds of dilution in the last 5 months. Many traders are focused on the fact that the company reported a heavy net loss in their last major filing, and they are waiting for audited 2025 numbers before they commit. The narrative is one of caution, where the wait-and-see approach is dominating the headlines. However, when you challenge that belief with recent price action and volume patterns, a different picture emerges. We are seeing institutional positioning that suggests a very different outcome for 2026. Management recently issued guidance for $350 million in revenue for the full year 2026, which is nearly double what the analyst consensus was expecting just a few months ago. Even more striking is the exit run rate target of $500 million in annual recurring revenue by the end of this year. We saw a record December 2025, where the company actually hit profitability for the first time with over $17 million in monthly revenue. This shift from burn to leverage is the inflection point that most retail investors are missing while they focus on the daily price swings of a few cents. Comment how many shares you currently hold and whether you think this $350 million revenue guide is realistic or just management puffery. The trading volume today is sitting around 20 million shares, which is slightly below the 20-day average. This indicates that we are not seeing a mass exodus, but rather a period of consolidation. Looking at the institutional behavior, several fundamental investors led the recent $250 million round, which shows they are willing to put up fresh capital at these levels even after the previous offering in September. These are not short-term flippers. They are building positions for what the company calls the agentic commerce revolution. The sector momentum for software infrastructure is mixed today, but RZLV has consistently shown stock-specific volatility that decouples from the broader indices, especially when news breaks regarding their agentic checkout protocols. Short-selling awareness is a critical piece of the RZLV puzzle. Current data shows short interest sitting at roughly 34.7 million shares, representing nearly 30% of the float. This is a significant level of pressure. Firms like Culper Research or other short-focused outfits have been known to look at SPAC-born companies with high growth projections with a skeptical eye, often pointing to the gap between contracted revenue and realized cash flow. The short thesis here is likely centered on the sustainability of their organic growth versus acquisitions and the potential for further dilution if they decide to chase more M&A targets. However, the counter-argument is that the $250 million they just raised effectively kills the bankruptcy or liquidity crisis short play for the foreseeable future. If the company hits even 80% of its guidance, those shorts will find themselves in a very tight spot given the low float and high institutional ownership. Retail investors can track this by watching the borrow rate, which has fluctuated between 2.
To understand what Rezolve actually does, you have to look past the AI buzzwords. They provide the transaction layer for AI agents. In simpler terms, as people start using AI assistants to shop, the assistants need a way to actually execute the payment and checkout without a human clicking through 5 pages of a website. Rezolve builds the infrastructure that allows a brand's AI to talk to a user's AI to finish a sale securely. Their business model is a mix of cloud-based subscriptions and transaction fees. They recently unveiled a new revenue model called SQD, which links enterprise usage to their data infrastructure. Past performance showed a company that was struggling to gain traction, with only a few $100,000 in revenue, but that changed in 2025 as their partnerships with Microsoft and Google shifted from pilots to full production. Retail sentiment on forums like Reddit and X is currently a battleground. On the r/RZLV community, there is a divide between the longs, who are projecting a $1 billion ARR by 2027, and the bears, who are frustrated by the recent dilutions. Some users are calling for more transparency in the upcoming 20F filing, while others are highlighting the joint demos with Microsoft at the NRF 2026 conference as proof of life. There is a strong contingent of retail traders who believe the stock is being held down by market makers to allow institutions to load up before the next earnings call. While coordination is often discussed, the reality is that the volume is driven by the macro shift into AI infrastructure. What's your take on the rising short interest? Do you think the bears have a point about the dilution, or are they about to get caught in a squeeze? Looking toward the future, there are three distinct scenarios. In the bullish case, Rezolve converts its $209 million in already contracted revenue into a steady monthly stream of $20 million plus by mid-year, easily hitting their $350 million target. If they announce a major partnership with a Tier 1 global retailer that integrates agentic checkout natively, we could see a valuation re-rating that brings them closer to their software peers, who trade at 10 to 15 times revenue. The neutral case is that they stay in this $2.50 to $4.50 range for most of 2026, as the market waits for more audited proof of their profitability. The bearish case involves a slowdown in enterprise AI spending or a technical failure in their proprietary large language model known as brainpower. If they miss their quarterly milestones, the stock could easily retest the $1.50 levels, despite the cash on the balance sheet. The core insight here is the massive disconnect between the current market cap and the projected revenue. If a company is guiding for $350 million in revenue and has $250 million in cash, a $1 billion valuation is remarkably low for the software sector. The expectation from the general public is that this is a show-me story, but the reality is that the institutions have already seen enough to write very large checks. The volatility is the price of admission for a company trying to build the plumbing for a new trillion-dollar market in autonomous commerce. Expect the swings to continue, but keep your eyes on the monthly ARR updates rather than the daily tick. Reality is slowly catching up to the hype, and for Rezolve AI, 2026 is the year where the math either solidifies or the narrative breaks. Would you like me to analyze the recent short borrow rate spikes, or perhaps look into the institutional buyers from the last $250 million round?